front. Also, US producer prices rose 2.6% versus the street estimate of 3.3% rise. Core PPI, which excludes volatile food and energy prices, also was off 0.1% after being expected to increase at 0.3% as well. My colleague Rabinder is joining with more details on this data.
Well, yes, in August, US PPI slipped 0.1% versus the street versus the estimate of 0.3% month-on-month basis. While if we talk about on an annually basis, then the estimate was 3.3%, but the actual figure came at 2.6%. And the tobacco products, which were impacted by the tariff, jumped 2.3% in August. Now, if we look at some of the past trends of US PPI, then in July, where the producer price surged 0.9%, far above the 2.2% estimate, driving annual inflation of up to 3.3%, and in June it was flat, showing no monthly change versus a 0.2% forecast, with the year-on-year inflation easing back to 2.4%. And final demand excluding food and energy fell 0.1% month-on-month basis in August against the expectation of 0.3% rise, and on a yearly basis it increased to 2.8% below the 3.5% estimate. Meanwhile, final demand excluding food, energy and trade services rose 0.3% month-on-month and 2.8% over a year-on-year basis. And the wholesale price fell slightly in August, giving the Fed more room to cut interest at the meeting this month. And Fed meeting featured both a rate decisions and an update on where they see the economy and interest rate ahead in the future. And the stock market futures slightly gained after the PPI release, while treasury yields were slightly negative.
All right, so stock market reaction, which comes in after the US PPI numbers, but we also have an expert to decode the same. Manish Singh, market expert, is joining us to decode this data. Mr. Singh, first question to you. Now, this data is much better than what market had anticipated. Do you think it will have a bearing on the announcements which are due next week by US?
Well, I hope so, because a lot of people have been talking about that inflation is going to come back, and I have been many times in your program and other programs, and my view has been very straightforward, is that I don't see an inflation factor coming in. Rather, everything that you're going to see is going to be disinflationary. And think back to what happened prior to COVID. Prior to COVID, the whole world was in disinflation. Remember where the rates were. And then we had a temporary shutdown of the economy. Supplies got disrupted. Those supplies have come back in. And in the meantime, the technology has gotten better, more investment has been made. So naturally, one would expect that the disinflationary trend should continue. And then you had tariff coming in the middle, and that complicated things a bit. But again, tariff is just one-time increase in price. And I know President Trump has been changing his mind frequently about rates, but a lot of the punitive tariff has gone away. And there seems to be an agreement that the tariff should apply at 20%. Well, not in case of India, but at least for majority of the nation. So if you take those things into account, then as I've said in the past, I don't see where inflation is going to come from. And the data is just showing us that it is going to be disinflationary. And therefore, the Fed now is on a very sticky wicket, having said that they're not going to cut rates. I believe they will be forced to cut rates by 50 basis points next week when they meet on 17th of September.
All right, so the expectation coming in from him is 50 basis point cut. But let's also shift focus how markets are behaving after this data. S&P 500 has hit a new record high in trade, and the tech-heavy NASDAQ is also trading in the green. In fact, if you talk about Dow Jones as we speak, it's currently trading in the red territory and has opened 100 points down. Manish, help us decode actually what I was talking about is earlier futures did show some reaction, but Dow Jones, I can see if the rates are correct, 100 points down. How do you interpret this kind of market reaction, Manish?
You see, largely the index is up because Dow Jones 100 point that you say is 0.2%. 0.2% move can happen on any given day, whether you have any announcement or not. Having said that, what we also have to be mindful of is that these things should not be leading to any contraction in GDP, i.e. lower GDP growth, because equities are not going to go up if the growth is going to lag. if the growth is going to lag, then that becomes a big problem. So if you see the jobs revision that we got yesterday of 900,000 fewer jobs being created over a 12-month period until this March, tells you that the economy was not in a very good condition. The data we saw on jobs front were overstated. So there is a view that one can take that maybe we've seen some sort of a recession last year and we're coming out of it. If you take that view, then you get excited about things going forward. Now, if you take the contrary view, is that we haven't seen recession last year and we are about to get into recession now, then the rate cuts are going to be much more than people anticipate. Irrespective of which view you take on, the fact that the rates are so high, above 4%, when inflation is on two handle, just begs the question that how long the rates can be at that level. And the rate cuts are going to boost certain sectors, definitely, financials and other sectors, and also all the growth stocks, which get priced off interest rate curve. If the yields are higher, then those stocks come down. So you will see the equities do well. But bear in mind that if there is any signs of recession or growth slowing down, then that is not going to be positive for equities.
Right. Donald Trump has once again put on his views on social media, calling no inflation too late, must lower the rate, as he was saying before, big right now, and of course, once again maintaining that Powell is a real disaster. So all in all, he's once again asking Fed to cut rates. And Manish, you have mentioned that 50 basis point is what expectations you have. Do you think this kind of pressure tactics actually work?
Oh, and it shouldn't work. I don't think that I believe that President Trump is right in many things he says, but you should never be putting pressure on a central banker. And remember, Chairman Powell, you saw about the expenses regarding the refurbishment of Federal Reserve buildings. Chairman Powell was not hired as a manager to look after the expenses of refurbishment. So I think those things are not in good spirit. It should never be done. But one has to take note that a lot of what President Trump has said about inflation was correct. It's not just him. There are many commentators, including myself, who've said that inflation is not a problem and Fed should be cutting rates. So in that context, he is right and he's being vindicated. But a president should never be interfering in central bank policies. And central bank, to the same extent, if central bank is concerned about its independence, then they should not be very academic about everything. They should not be relying on old models, and they should be looking at what the real data is and real economy is doing. And just final point, if you look at the jobs number that has been come out, which is what Fed has been relying on, if the Fed was said today that 1 million fewer jobs were created or 1 million fewer jobs were being created last year, so there has been a reduction of 2 million jobs over the last 3 years, Fed should have started cutting rates long time ago if they knew that. They didn't know that, but that's not an excuse. I think that you have to be forward-looking. In my opinion, Fed is behind the curve. It is too academic, so President Trump is justified in raising those concerns.
Point well taken that, of course, the politics and policy should have some distance, but yes, the policy action should be data-driven. Thank you so much for joining with your views, Manish.